This is the Daily Market Rundown live from the Tradelo trading floor. It's July the 17th. Some highlights from today's show. Trump is testing the market's appetite for firing Powell. US long bond yields are 8 basis points from 2007 highs, and dealers are set to support the breakout. Good day traders, and welcome and a happy summer month trading. I think it's important to start at that point because we are firmly in summer markets now. We can see that across the board in the volumes. We know it's been light all week, and we know that the only reason we've actually had any kind of movement in most of the markets is because of some of the headline risk. Now, that risk, of course, is what drove markets yesterday. It was again this continued bombardment of the Fed President Powell, Mr. Late, obviously, who he's been labeled by President Trump. And ultimately what happened yesterday, as we get on to our first topic, was very much a test for the market. So what do I mean by this? Well, look, we know if we go back to April and where we had the Liberation Day tariffs, ultimately Trump, 48 hours prior to giving a 90-day extension, came out and he tested the markets then as well because he wanted to see the market's reaction function and how it would respond should he give a 90-day extension. Okay, he seemingly continues to do this. The way Trump is doing things now is very simple. He wants to gauge markets' reaction to certain things. If it works in a way that he thinks, he'll then follow through. If it doesn't, he'll hold off and find alternative options. Now, it's important to stress this because if you've been following Powell all year and you've been following the Daily Market Rundown, you'll know that ultimately Trump does not want to upset the markets. Okay, so what this means, and this is key, whenever Trump wants to do something negative to the markets, in other words, he needs to ultimately deliver some bad news that's going to upset markets, he'll typically do it over the weekend. Why? Because he's then got 48 hours to drive the narrative. Okay, think when the markets are open, if you deliver bad news, it's very difficult to drive the narrative because everyone simply just wants to hedge the risk. Okay, when there's 48 hours, there's a lot of opportunity to talk things down, walk things back, ultimately create space in which you can reduce the likely market impact as well as the volatility. Okay, so that's important to stress. Bad things that the president wants to announce, he does over the weekend, so he's got time. Good things, he does absolutely when the markets open. Why? Because he gets maximum bang for buck. Okay, important to stress that. Why? Because yesterday things took another step forward. Okay, if you've been following the whole Trump-Powell saga, this didn't start yesterday. This has been ongoing now for a month. But yesterday was again another step forward in terms of escalation. We know that the wording that's been used towards the president of the Fed has been quite negative. But yesterday was this sort of idea was floated that Trump in the White House, with some of the Republican lawmakers, it kind of said, hey, what do you guys think? Should I fire him? And there was a general consensus that the absolute majority thought that yes, they should fire him. There was even a sort of a piece of paper apparently held up with sort of a signature from the president. And again, all of this was walked back, but ultimately this was very intentionally done. Okay, Trump is trying to gauge exactly what the market's response is going to be should he fire Powell. Now, we know what it was yesterday. It was sell dollars, sell long bonds, and ultimately sell risk. That was the play for a Powell dismissal. Now, of course, it got walked back as no, I'm not planning on firing him, but ultimately do not take that at face value. Okay, I think what we have to take at face value is that if he is going to fire Powell, okay, it's very possible we get something this weekend. Do not discount the fact that we get something this weekend. It's very possible that something is unearthed, released to the media late on Friday after the market close, finding Powell, of course, in contempt of the law. Ultimately, he's done something fraudulent, and ultimately what we get on a Saturday morning is Trump is moving to fire Powell, something along those lines. Okay. Now, again, I don't think necessarily that's the base case. Okay, I don't think we're at that point yet. I think that point is definitely coming. I think the likelihood of Powell being dismissed ahead of his time is absolutely, probability-wise, I think it's greater than 50%. Okay. More importantly, and this is a scenario which I actually think is more likely, and I think it's a scenario that's going to play out, is ultimately Trump forces Powell into resigning. Okay, there's a number of ways he can do this, and so far the way he's keeping up with the really negative commentary towards the chairman, ultimately I think that's going to eventually lead Powell to saying, well, look, hang on a sec, I want to preserve the Fed. Yeah, I don't want to be the one that's creating concern around the credibility of the Fed, therefore I'm going to take a step back. Okay, now of course these sorts of conversations will be going on behind closed doors. Maybe there'll be some wonderful packages offered to Powell to just leave quietly and leave behind the premise of, he wants to safeguard the independence of the Fed. Okay, we just don't know. The point is, I think a resignation of Powell is a far greater likelihood. I do not think he sits out his term till May next year, despite what he says. I think that resignation will come sooner rather than later, perhaps before Jackson Hole. It makes absolute sense. Because why? Look, if he resigns in August, don't forget the market's pricing of a September cut is already 60%. Okay, in other words, it wouldn't be a shock to the market if he resigns. Now, sure, there'll be an initial risk-off move. Sure, there'll be a, he got pushed off the plank type response from the markets. But the reality is that at the end of the day, it wouldn't be problematic, particularly for long bonds. Why? Because the market's already pricing in that cut in September. Okay, now sure, it does open the door to perhaps steeper cuts or maybe more cuts. But again, there's not just one member at the Fed. There are, of course, 18 voting members. And so it's not a case of just because someone else is coming along that suddenly, everything is going to become chaotic. So I think a resignation is the far more likely outcome. And again, I think the way that also will happen is we'll see this continued upkeep of battering the Fed chair, continued negative talk toward the Fed chair. And ultimately, I think eventually that's going to lead Powell to just say, look, I don't want this for the Fed. It's a credible institution. I'm taking that step back. Okay. Now, very, very important. I know I've gone on a bit of a tandem there, but there is something else that's perhaps going to force the hand of the Fed, force Powell to take that step back. And I think it's going to come in the form of the long bonds. Okay. What you're seeing is the 30-year bond yield here now. And I think it's very, very, very important to stress notice how despite the fact that, it did get walked back from President Trump yesterday, right now the 30-year bond is currently sitting around 15 basis points higher over the course of effectively not even a week. Okay, that might seem like a little. If you're not a bond trader, it might seem like what is he talking about? 15 basis points in the 30-year bond when we've had absolutely no news this week. We've had no news, anything fundamentally to drive the 30-year over the last couple of weeks, and yet the 30-year bond is up 15 basis points. Now, there's a very good reason for this, and this is what you need to take from it. Right now, the bond markets are pricing in a higher probability that Powell steps back or gets fired. Okay, so you won't see it so much in the equities. The VIX is very, very low. You won't see it there. You can see it a little bit in the dollar. But right now, the long bonds are hedging against the Powell removal. Okay. Moreover, they are also hedging ultimately against a far more relaxed financial conditions coming over the course of the next 12 to 18 months. Okay. In other words, the long bonds are sniffing out that we are going to see those rate cuts coming. We are going to see a Fed eventually, give up and give in to President Trump's demand for lower rates. That's why the long bond yields are starting to move higher. Okay. They are pricing in these risks at the moment. Okay. We've been talking about the chart for some time now. You can see we broke out of this sort of nothing channel, this 20 basis points channel that we were in for 3 months, and all of a sudden we've done 15 basis points. We've done this entire range in the course of the last 5 trading sessions. Okay, switch on to this chart. No doubt we are going to test that 510, 515 next week. Don't forget, all of this is coming, and this is key. This week we had a miss on CPI, we had a miss on the PPI, and we're still seeing ultimately 30-year bonds rising. Okay, it's telling you everything you need to know, which is the markets are getting ahead of this idea of a dovish Fed that's ultimately coming in. Okay. Now, there's another great article out about stock market valuations. I think this is a good one to sort of look at, because I think if you go back 20 years ago, valuations meant a lot. But what valuations are good for is just understanding how expensive or how cheap markets generally are. Now, this article is going on about, ultimately, we don't know if they're expensive or cheap. We know they are back at historic highs. Okay, so we know price earnings, forward price for PE is at 22.2, which is effectively the highest it's been in terms of, data keeping. We also know that it's 40% above the average of the 40-year. Okay, the 40-year average is around 15, 16. In other words, if we were just to take a pure sort of chart and look at it, we would all agree that right now, forward price earnings are relatively expensive. The market is pricing in a very perfect scenario moving forward. Okay. Now, that's the one side of the argument. The other side of the argument is this justified? Okay, is the fact that tech dominates most of these indices and that AI is going to create significant amounts of growth and therefore earnings, ultimately earnings could be a lot higher. And I think that's the other side of the argument, is that it's cheap if you think that AI is going to drive 3% growth into the future. Okay. For me, what's important to take away from all of this is to say to yourself, okay, in the current market environment where prices are, is a 22 PE make sense? Perhaps yes. Okay. But you have to ask yourself, what ultimately drives us to a 25 PE? In other words, we need a new fundamental catalyst if we're going to get the S&P and the Nasdaq and the Russell to continue to rally into record highs. Okay, and that's what we have to try and interpret as traders. For me, there is a catalyst, and it's very simple. If all of a sudden, and this is key, if all of a sudden, the Fed comes out and says, well, hang on a sec, actually, the tariff impact of inflation is not as great as we thought, okay, ultimately what they're going to signal is that they've got a lot of room to cut. They can remove the restrictive policy around 150 basis points relatively quickly. And what that's going to do is it's going to create a revision to growth expectations. Okay, we haven't yet had that revision to growth expectations. The expectation is still for a 1.6 GDP growth this year. And that's really, really important to stress, because should the Fed be capable of cutting because and only because inflation is coming down to target quicker than what they thought, and there's very little impact from the tariffs, ultimately, if they can cut quicker, you will see a revision higher in growth expectations. And guess what? That's going to be a rocket fuel for the stock market. Okay, that is going to allow price earnings to move up to 24 to 25 with relative ease. Okay, and that is the thesis I think you've got to be very switched on for. We are just not seeing a pass-through of inflation right now. And until we do see it, ultimately you have to sort of look at this with one eye. And I think the markets are looking at it like that. They're looking and saying, well, hang on a sec, we're not seeing this tariff inflation that the Fed's barking on about, and so perhaps they are wrong, and perhaps they are behind the curve, and perhaps they need to cut a lot quicker. Okay, keep an eye on that. I think it is definitely a play we will be focusing on in the second half of this year. If we get a reacceleration of growth, guess what? S&P is going to find its way to 7,000 pretty darn fast. Now, with that in mind, just looking at the charts, okay, sure. We're all traders. We all look at this. We all draw squiggly lines. We all look at 200 moving average and say, well, you know what? That spread between current price and 200-day is wide. It's historically wide. It's wide on every level. We've gone up in a straight line. We're up 40% in the Nasdaq since the April lows. An objective mind says this is overboard. An objective mind says, this can't go on and on. Okay, but the reality is that, like I said, should growth expectations be revised high, well then guess what? Yes, this can go on, and it can go on for a lot longer, simply because there's a lot of cash on the sidelines waiting for some form of a pullback. Okay, now with that in mind, this is a weekly chart, and what you can see is a very important sequence here in the Nasdaq. It is one-time framing. Okay, in other words, we have not closed below a weekly low since April. Okay, you want to go short the market? Just wait for the weekly candle to close below a previous week low. Okay, that will signal out some form of a correction, but until we get that point, it's no point turning bearish the markets. Okay, if we look at the S&P, we look at the rebasing actually, we can see what's driving all of this. We can see European equities have been very, very strong. They have taken a little bit of a setback over the course of this month with what's going in terms of the tariffs and the threats of 30% tariff on Europe. But we can see, of course, Nasdaq's only up 8% this year, S&P only up 4.8%, and of course we know the Russell's flat this year. Okay, in other words, year over year, these indices are up, but they still have a lot of room to the upside. Okay, should we see those growth revisions, should we see inflation come back to target, you know what to do. Okay, S&P will have double-digit growth, double-digit percentage growth this year, as well as Nasdaq, and we will perhaps also start to see, and this is important, we'll start to see the Russell outperform. Okay, very, very, very key play. If the Fed can cut a lot quicker, because ultimately inflation is not as problematic, Russell's ultimately the one that's going to get back to that record high a lot quicker, because it has been massively underperforming, not just this year, but of course last year. Okay, and then finally we have got retail sales out today. It's pretty much the only data point out. It is one to watch alongside the initial jobless claims. Now again, retail sales is one of those things that it's kind of a bit of a snooze fest, but what we can do, I mean, you've got obviously the expectations there, you've got the ranges, you can go and have a look at that. What are we looking for? Okay, what's an outlier? We know ultimately that the consumer demand is weakening. We know that that's ultimately what's driving a slowdown in GDP expectations. It's just a consumer that's a bit tapped out, a consumer that's a bit uncertain, a consumer that's really running into higher inflation. So we know it's ultimately at the consumer level where we are going to see some form of maybe the US economy cracking, if it cracks. Okay, so just to have a look at 2008. I think very, very important. You can see how, if we go to June, which was kind of, June 2008, you can see things were looking really, really good at a consumer level. Okay, and it was all of a sudden as we moved off into the back end of the year, September, October, all of a sudden, you know, we got these really big negative prints, -1% month over month, -1.5%, -2%, and eventually we had a -4% print at the low in 2008, 2009. Okay, so again, not saying we're going to get that, but just pointing out, if we got a shock number, okay, if we got a minus 0.8% today, when the expectation for the ex auto and gas is 0.3, if you got a -0.5%, that's going to scare the markets a little bit into thinking, well, hang on a sec, did the consumer just fall off a cliff or what? Okay, so keep an eye on that. It's not one that typically moves the market a great deal, but you still need to know where those outliers are, because at some point we may get one of those head scratcher type numbers, and we do need to be prepared for that. Okay, and then finally, just looking ahead to expectations for today, I think the key thing, not just today but this week, has been that these markets are dead. Okay, volumes are low, markets are moving and then they're dying. Okay, in other words, they're typically just sniffing out a little bit where there might be some liquidity in the market. They're trading towards them, and then they're moving in a sideways fashion. Okay, this makes trading very difficult, particularly for day traders, because there's not a great deal of work for us to do. Okay, now what you're looking at here is just having a look at some of the gamma exposure, particularly as we move into OPEX. Okay, as we move into OPEX, we need to understand what's going to happen before and post OPEX. Now, if you look at the orange line and of course the dotted line, it's pointing to something very, very interesting in terms of what happens as we move in and beyond OPEX. Okay, and again, this will make a lot of sense when I show you the chart, but ultimately you can see this line drops off. In other words, we go from quite a positive gamma environment to a negative environment, and then suddenly we go back to a positive environment somewhere in and around these prices over here. I'm going to draw a nice little box. Okay, and then beyond that we suddenly go into a very negative gamma environment. Okay, so what's happening here ultimately is that the market's in a very, or at least the dealers are ultimately in a very positive gamma environment, somewhere between 6200 and 6300. Okay, once we get beyond 6300, we can see it goes into a very negative environment. Once we go below 6200, we go into a very negative environment. Okay, what does that mean? Well, if we go and have a look at the chart of the SPX now, they're those same lines, 6200 and 6300. In other words, dealers are supporting the market here, and they are supporting the market here. In other words, they're keeping the market contained between 6200 and 6300. But what happens beyond there is below 6200, they're actually going to turn and start selling the market. And above 6300, they're going to start turning and buying the market. Okay, and this should be quite nice, particularly if you're a breakout trader, because we're all looking at this going, wow, we have quite a nice looking flag. But ultimately what it means for us as day traders is that when we get above 6300, we're going to get a lot of gamma flow. We're going to get a lot of dealer hedging that's going to support the breakout. Okay, same to the downside. We break the downside, we're going to get the dealers helping us out. Okay, now the speed at which they help us out will depend a lot on ultimately the gamma and what time of day it happens and all that sort of thing, and we'll discuss it when we get closer to it. The point is there will be some work to do in the S&P. I don't think it's going to happen today. I don't think we're going anywhere today, and I don't think we're going anywhere tomorrow. But I definitely think this is a play for next week as we move into the back half of July. Okay, with that in mind then, if there are any other questions, do post them in the Discord channel. Like I said, keep it tidy out there. It's not really a day that you want to go making your month or your week. It is summer markets now, so we have to accept that. Like I said, keep a very close eye on the news headlines, the news flow, because we know that the President Trump can say anything at any moment. Otherwise, good luck out there today. Go manage that risk. Go make some money.